In this week's market update, the Fed meeting dominates the agenda just as the Bank of England's did last week. US equities hit new highs as risk appetite returns, Germany goes to the polls, and Brexit is in focus, with a key speech from Theresa May and a leadership challenge bubbling up ahead of the Conservative Party conference. Central banks continue in the spotlight this week as the Fed's two-day rate-setting meeting comes into focus today and tomorrow. The US Central Bank is expected to leave short-term interest rates unchanged at between 1 and 1.25%. They're unconvinced that a recent pickup in inflation really marks a sea change after 5 months of tepid prices data. Consumer price inflation rose to 1.9% in August, up from 1.7%, but Fed watchers don't believe this will be enough to convince Janet Yellen and her fellow rate setters to pull the trigger this week. More likely is a further rate hike in December, but even this is far from being a given. Continuing strength in the US jobs market would normally argue for a move on interest rates. The jobless rate has fallen to 4.4%, but wage inflation is still notable for its absence. Key members of the Fed committee are worried that long-term structural forces may be holding inflation down. Although the unemployment rate has averaged 5% over the past 3 years, that's similar to the level just before the financial crisis, the inflation rate has been markedly lower, 1.5% versus 2.2%. So the traditional relationship between the job market and inflation appears to have broken down in the post-crisis world. The so-called dot plots, which signal rate setters' view of future rate rises, will be the key indicator of whether the Fed is braced for lower for longer policy than it had previously expected. Although the outlook for interest rates is murky, there's less doubt that the Fed will set out its plan for reducing the size of the central bank's balance sheet. That's ballooned since the financial crisis on the back of the massive quantitative easing stimulus program. The balance sheet expanded by $3.7 trillion as a result, and the plan is to reduce that by between $1 trillion and $2 trillion over the next 5 years or so. Last week, it was the Bank of England's moment in the sun, as it left interest rates unchanged, but gave the broadest of hints that interest rates will be moving upwards in the next few months. The likelihood of higher rates soon was increased by the conversion of one of the bank's most dovish members, adding his voice to those calling for an end to a decade of historically low borrowing costs. Gertjan Vlieger's change of heart means that a majority of the 9-person Monetary Policy Committee now think it will be appropriate to raise rates from their 300-year low over the coming months. The market impact of last week's meeting was dramatic. The pound leapt above the $1.36 mark as investors positioned themselves for a higher yielding currency by international standards. Sterling rose against the dollar by 2.7% in just 48 hours. The trigger for the bank's more hawkish tone was inflation data earlier in the week, which saw the CPI rise to 2.9%, its highest level in 5 years and well above the bank's 2% target. Unemployment, meanwhile, hit a 42-year low. Just like the US, this is not yet feeding through to higher wages, which continue to lag inflation. But with the abandonment of the government's multi-year public sector pay cap, the prospect of rising wages is greater today than it has been for many years. The impact of the rising pound on the equity market was also marked, with the FTSE 100 falling by more than 2% last week, as the outlook for the blue chip index's exporters and overseas earners darkened. The UK stock market and the currency tend to move in opposite directions, thanks to the strongly international flavour of Britain's biggest companies. Now, whether the recent uptick in interest rate expectations actually delivers tighter policy is open to question. There are plenty of reasons to think that rates will remain lower for longer. These include the inability of retailers to pass on higher input costs thanks to the competitiveness of the high street, the persistence of stagnant wages, the depressing impact of stalled Brexit negotiations, ongoing weakness in the economy as shown by weaker car sales and lower consumer confidence, and finally, recent form. The Bank of England has threatened higher interest rates before and then backtracked, earning Mark Carney a tag as the boy who cried wolf. The difference in outlook for interest rates was one reason why the US and UK stock markets diverged last week. Unusually, in an era when global markets tend to move in lockstep, the US has gone on to hit new highs while the UK has seemingly lost its momentum. The S&P 500 index was 1.5% higher last week, in part because fears about North Korea eased despite the launch of another test missile, and the insurance industry reduced its estimates of the cost of hurricanes Harvey and Irma. In Japan, the Nikkei added 3.3% last week as good news on the economy and corporate earnings allowed investors to shrug off Korean fears. In Europe too, strong economic recovery and an absence of political worries saw the market add 1.3%. So politics, which was such a big story earlier in the year, seems to have fallen off investors' radars, with Brexit losing its ability to worry the markets and the week's big event, the German election, looking like a foregone conclusion. No one seriously thinks that Angela Merkel will not be returned for another term, with a continuation of the so-called Grand Coalition between her Christian Democratic Union and the left-of-centre Social Democrats. A year ago, markets were fretting about the rise of extremism in Europe, but victories for the mainstream in Austria, France and Holland, and the likelihood of more of the same in Germany, have taken the pressure off. Germany's stock market has risen by 9% year to date, outpacing France's 7% gain and easily beating the UK's 3% rise for the FTSE 100. This has been despite a 13% rise in the euro against the dollar, which makes life tougher for Germany's big export sector. Meanwhile, Europe seems to have got used to the continuing political intrigue in Britain and priced it in. This despite the apparent launch of a leadership bid by Boris Johnson, who's doubled down on his hard Brexit position just days ahead of a key speech in Florence by Prime Minister Theresa May. That's on Friday. Looking beyond these perennial market stories to other significant movers, oil is back in focus as it rose to above $55 a barrel for Brent, its highest level since April. Investors seem to have gained reassurance that a synchronized global recovery will boost demand for crude, while the recent storms in the Caribbean have been a reminder that supply shocks can come out of the blue. Technical analysts think the oil price might be poised to break out of its long-established sideways trend, with the 50-day moving average approaching the 200-day measure. Chartists usually treat the shorter-term average rising above the longer one as a bullish sign that momentum is upwards. Meanwhile, another fascinating chart is that describing the exponential rise in the price of virtual currency Bitcoin. It recently soared to nearly $5,000, up from well under $1,000 earlier in the year. Some people, including JP Morgan boss Jamie Dimon, have warned that this is a classic asset price bubble. He drew comparison with the tulip mania in the 1600s and many other moments of market madness since then. And finally, Brazil is in focus this week as the stock market hits a series of new highs despite a deepening political crisis, as the country's independent chief prosecutor files indictments naming senior politicians including the president Michel Temer. His popularity has hit an approval rating of just 5%. Despite this, investors have given their approval to his reform agenda, which is aimed at reducing Brazil's runaway budget deficit. As one local economist put it, I don't know if the market and society are on the same page.